This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Serezna.
Eric, it was great to have Lynn back on the show. Now let's get to that chart deck. Listeners, you're going to find the download link for the post-game chart deck in your Research Roundup email. If you don't have a Research Roundup email, it means you have not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Lynn's picture saying, looking for the downloads. All right, Eric, let's start off with your thoughts here on the equity markets.
Well, I got filled on all of my September E-mini S&P futures hedges, so I say let the downside fireworks begin. Crash this market. No, seriously, I do think there's plenty of room for another round of policy-induced market turbulence on par with the April tariff tantrum, if Trump and Bessent launch a new round of policy initiatives, which I think is likely and probably coming pretty soon. But I don't think this market is going to roll over or see any meaningful downside until there's a downside catalyst. And so far, we don't have that catalyst quite yet. If anyone has my confidence to bring us one, it's our president.
Well, Eric, certainly there's lots of room for headline-driven volatility, but overall, the market remains in a primary bull trend, but it is overextended. The way I would kind of describe it is that we're like in the 7th, 8th inning of a advance higher. There's more game potentially still to be played, but there's very little asymmetry in just starting brand new buying up at these higher levels without there being some sort of a consolidation or mean reversion that resets the payoff profile of your entry. At this moment, it's one of those scenarios where there's not much catalyst until next week for the markets to start swinging. Once we get into those inflation numbers and bank earnings and we get past the options expiration pinning that could be getting underway, there's room for end of July volatility. But even then, we probably have to go through a bigger topping formation in this market that will keep these markets at these elevated levels through a good part of the summer. At some stage, there's going to be a reason for this market to go through a profit-taking cycle or some deeper market correction. But really, there's very little evidence that this is imminent. And so we have to just expect the markets to remain in this primary trend for the ongoing period. All right, so now let's move on here and talk about this dollar.
Well, we're bouncing a little bit this week on the Dixie, but we're still in line with an overall downtrend pattern. And the short-term outlook is really hard to call on this market because on one hand, you've got a strong structural downtrend that's bearish. On the other hand, you've got a badly oversold structural downtrend that's bearish, and therefore it's overdue for at least a short-term counter-trend rally or bounce. So that's short-term bullish. It could go either way. At some point, we'll get that counter-trend rally. I think that would be the opportunity, is shorting it at the top of that next rally.
Well, that's exactly it, Eric. There's a primary downtrend. The bounce that we had over the last week couldn't even get above the 98 level on the Dixie. Basically, even though very oversold and had every reason to begin some meaningful bounce, it had almost no follow-through whatsoever on any rallying, which basically shows just how dominant the selling pressure remains in the dollar. And the vulnerable downside break is still there as the path of least resistance. At some point, this very oversold dollar is going to be given a catalyst to do a squeeze on the upside. But again, there seems to be a lack of a catalyst emergent yet and no trigger point that has actually started it. We'll see whether by the end of the month there's something that emerges that can begin some sort of a counter trend squeeze. But at this moment, expecting the dollar to remain in this primary downtrend is the path of least resistance. All right, Eric, let's touch on oil.
Well, Patrick, so far, my hypothesis that I shared with our listeners a few weeks ago that you might have had a second chance there to buy oil on a 64 handle when we talked about it on MacroVoices seems to be playing out nicely. Now, I have a term structure trade on. I didn't buy the outright position there, and the reason is I still see lots of room for the next round of Trump policy surprise to involve some kind of deal. Let's say President Trump makes a deal with Saudi Arabia, with Mohammed bin Salman, and says, look, let's just get OPEC to turn the screws up to maximum production, bring the oil prices down as much as you possibly can until this Iran conflict is over. Do that for me, MBS, and I'll make it up to you later with another favor. Maybe they'll let them do something else later in the market when they want higher prices. I don't know. My point is simply that I think there's plenty of room for President Trump to bring prices down through policy initiative, and we don't know what that next policy initiative is going to be. Now, his next policy could easily spike the market in the other direction. The point is, it's a headline-driven market. I don't have the inside information. I don't want to make a directional call here. I will make the directional call on the time spreads, though, and I'm still long that position and expecting that to continue to develop as we get closer to expiry.
Well, Eric, my perspective on oil is a little bit more neutral. I don't actually anticipate oil breaking back down to the lows where we were trading through April and May down in the mid-50s. I think that a new risk premium still has to be accounted for, and the fact that the economy hasn't turned to a recession means that oil prices probably didn't belong south of $60. Now, at the same time, is there a reason for there to be, at this moment, a new bull market in oil? Probably not. But we spent over 6 months in a trade range between the 66 to low 70s, and essentially oil staying in that trade range is entirely plausible. So oil trading up into the mid to low 70s before starting some sort of a correction back to the bottom end of that range would be a very natural sideways trade range that I think can continue as we move forward from here. All right, Eric, let's touch on gold here.
Well, Patrick, this gold bull market is, I think, getting into its later stages and not feeling as exuberant as it did a few months ago. The fundamentals still look really good, but we need to get back above that 50-day moving average. That's around 3340 or so, 3340 on the front month, which is the August futures contract. If it doesn't hold, the last time that 50-day didn't hold was November of 24. When it didn't hold, we ended up with more than $100 of downside from there to get down to the 100-day moving average, which did hold. And if that happened this time, in other words, if the 50 doesn't hold here and it ends up that we get down to the 100-day, well, that's down at 3196. It'll be 3200 by the time we get to it. So that's about another $100 down, same as we had in November of 24, and that's another $100 below my last ad. Gives me an excuse to buy even more. I definitely think it's a buy the dip type of opportunity. It's a question of how deep is the dip, and it's starting to look like maybe this 3,300 key level is not going to hold at that 50-day moving average, and we're going to you have to go down and test the 100-day moving average at 3,200 before this is over. And again, the correction makes perfect sense. It happened after President Trump announced that there was no more risk and that he was de-escalating the conflict with Iran. I don't agree with his risk assessment, but his intention to de-escalate is what really mattered. And as long as that's the case, we're in a de-escalatory environment. Of course, the price of gold has come off and consolidated. Makes perfect sense.
Well, Eric, we remain in a pretty interesting multi-month consolidation. And now we've seen these types of multi-month consolidations in the past. Just if you look at that chart and look at that period between October through to early January, we had a period where gold literally just bounced around in a sideways trade range for 3-4 months before inevitably bullishly breaking out. Well, this looks very similar. We're trading along the 50-day moving average. We're trading in the center of a horizontal triangle consolidation that's been going on since the April high. Inevitably, gold is going to show its hand with a breakout. The question is there a bigger and deeper market correction in gold down to 3,000 for a buying opportunity? Or is this sideways horizontal triangle going to bullishly resolve itself and make a move to 3,800 on the upside, which would be the technical measured move? At this moment, it's very easy to trade this because the 50-day moving average is right here. And if this is going to be in a bull trend, it will remain above its 50-day moving average through that entire period. And so at this stage, we're just going to be watching this week whether or not gold can remain bullish at these levels, start breaking some of these key hurdles around 3,400 to really indicate that some sort of new accumulation cycle may be underway. All right, Eric, we got to talk about uranium because this has been one of the hottest and strongest markets out there. And finally, we've seen a little bit of stalling out and or reversion, including on this Sprott Physical Uranium Trust here. How do you size this up?
Well, I think it's really important to stress as we understand this fundamental picture. Nobody's really started to buy any meaningful amount of uranium yet. The amount of contracted, both spot market and contracted long-term delivery uranium deals that have happened in 2025 is still minuscule compared to both historical standards and annual consumption. This year's uranium buying hasn't even gotten started yet in any meaningful way, and we've already seen prices more than double off their April lows as everybody kind of got the memo from all the Trump executive orders and everything else that the nuclear renaissance is on, and it's on in spades. So it's all happening. That's great, but we're only just at the pregame. This isn't even the first inning yet. This is the pregame warm-up period before this bull market really starts to take off, or at least that's the way I'm reading it. We're finally seeing a little bit of consolidation in these uranium names coming off just a few percentage points from their recent highs. I hate doing this. I'm already starting to buy the dip, even though it's a minuscule dip. I really hope we're going to get a deeper dip before the summer is out, but I've kind of set August 15th as my deadline for getting my full position on. And that's going to involve buying a whole bunch of calls and call spreads on the URA ETF, which I've already started to accumulate. And no, I don't think these are great prices. I'm chasing it at these prices. I'm just afraid we're not going to get a meaningful pullback before August because too many people are lined up waiting to buy this dip that might not come. So I'm starting to nibble into this, still keeping some dry powder. I'll definitely buy more aggressively if we get a meaningful dip here, and I'm hoping that we'll get one. But I couldn't be more bullish in the long term, and I think it's after the WNA conference in early September that the buying will finally start and things will heat up. Probably the only caveat that I can think of is there's a lot of people that have that same view that this market's really going to take off after the WNA conference. Too many people all think the same thing. That means it usually doesn't happen that way. So that would be the one caveat, is too many people with that expectation.
Well, Eric, definitely there has been a full-on retracement in that Sprott Physical coming straight down to the moving averages. This is a level where typically buy-on-dip traders would be buying the dip on this asset. We're now trading at a meaningful discount to net asset value, which was at some point it was trading very close to the actual net asset value, which is very rare for a closed-end fund. And so now that we've seen this kind of a pullback, in order for the bull market to be really solidified, we want to see the buy on dip pattern come in here and then turn everything back up for a continuation pattern. One way or another, this is starting to get interesting here. Now, Eric, we have to talk about this copper move. Obviously, this is a big issue with the tariffs, a big gap higher. What are your thoughts?
Well, Patrick, the reason I wanted to get copper back into the conversation this week is that, to my thinking, by far the most important signal that we got from financial markets all week was the spike on copper prices that happened in reaction to President Trump declaring again that he might do a 50% copper tariff, or he was considering one. The point that I think is most important and which most people missed is that we're being told loud and clear that Trump and Bessent simply are not concerned about collateral damage in financial markets as a result of their policy initiatives. Copper has been a real policy flip-flop here. Just to remind everyone of the history, as we were getting the speculation of the coming Trump tariffs, which everybody knew were rumored to be coming but hadn't been announced yet. I'm going back into March and April now. At that point, everybody was front-running, buying copper, expecting it to get tariffed. Then when the announcements came out, it seemed to be that the Trump administration was announcing pretty clearly, no, guys, look, we want to support American business, so we're not going to be tariffing raw materials like iron ore and copper, which are the materials that we need to be able to buy economically in order to support as input costs to American business. We're trying to support American business, not cripple it. We want raw materials to cost less. We're not going to be tariffing things. That's when you saw the absolute crash in copper prices as a result of Trump saying tariffs were going to be exempt. So what we're seeing here amounts essentially to forward guidance, as the Fed has used that term in markets, but backwards. They're giving us misinformation or disinformation because it's part of the president's negotiating strategy or something. So what happens next? What's the next policy decision going to be? And it might not be copper prices. It might be something else. The point is, they're not worried about crashing a really important market, or in this case, spiking it up. In this one, a couple of months ago, it was crashing prices on copper down because they made an opposite announcement. Now, do you really believe, listeners, that President Trump is going to truly impose a global 50% copper, across the board copper tariff, as has been suggested or rumored, that would cripple American business and prevent them from accessing a really important raw material that they need in order to compete in global markets? Of course not. That's not what's going to happen. So probably in terms of copper itself, there's a good argument to be made here that it's a screaming short, because you would expect a full downside retrace as soon as President Trump announces, "Oh, I didn't really mean it. We're not really going to put a 50% tariff on copper. I was just bluffing." But wait a minute, what happens if the next policy initiative is something else we don't know is coming that ends up spiking copper in the other direction? Well, that's the reason I haven't put the trade on yet. The only thing you can really bet on here is a lot of volatility, a lot of uncertainty, and a lot of people with inside knowledge that you and I don't have making a killing here at the expense of everyone else. I don't see any other way to interpret the policy initiatives, and the only thing I can say is it's either capital preservation or have some kind of inside information where you think you know what the Trump administration is going to do next, and that's been an awfully difficult guessing game.
That tariff announcement drove a very clear technical bull breakout to all-time highs on copper. The bigger question here is there a trade in copper? And this is challenging because we could easily get a headline tomorrow that Trump is going to back down on this type of a tariff on copper, and this thing could be down 50 cents as fast it was up. And this is where, while certainly it's great for those people that have been long copper to have participated on this type of an upside, but the question here is it tradable? And to me, I'm going to be leaving it alone at this stage with this kind of a move. There's almost no asymmetry in being long copper at this level, but some of the individual copper stocks still have very nice clean charts, and probably where you could put a lot of attention to versus the actual metal itself.
And Patrick, before we close the show, let's hit that 10-year Treasury yield chart.
Yeah, Eric, just touching on those 10-year Treasury yields, you can observe that essentially all year, the 10-year yield has been pinned in one big horizontal triangle formation that has interest rates literally in the dead center of their high and low ranges for the year. There clearly has not yet been a decisive breakout. That's interesting because it's not necessarily the case on the long bond, which has had yields pressing much higher, or the short end, where we continue to see actual yields declining. And therefore, we have a scenario where the yield curve is actually reshaping. Nonetheless, the 10-year is the most important benchmark, and it's really not giving a clear signal yet. We'll be watching to see when the 10-year starts to wake up. Finally, Eric, I just wanted to touch on Bitcoin on page 9. And what I want to highlight is that here we've been waiting in a consolidation since May along its highs. And we're looking to see whether or not it was going to make this key breakout to a 52-week high. And here we are. And so we literally are seeing Bitcoin now attempting to make this breakout. That leaves measured moves all the way up to 120 and 130 on the upside. At this stage, Bitcoin continues to have a very clean bullish chart and continues to be very well supported on all dips. And so let's see how high they can take this.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.